portfolio optimization for 7-asset portfolio, which you can also apply this technique to others multi-asset portfolio as well. So let's get started. First thing first, you gotta download your historical data of the asset that you have. You can see that I already have mine here and I use investing.com to do so. Before we jump into calculation, we have to clean our data first. I have 7 assets here and why 5 though? Apple, Costco, JP Morgan, Microsoft, and S&P 500 are stock market index. Here is crude oil future contract, and here it is spot gold traded on foreign exchange market. So these two assets has a different system of trading days. For that, during the course of 5 years, gold and oil have more than 1,300 days trading, while, for example, S&P or only have about 12 and 50 days trading. If we do not clean our data, we cannot calculate very fundamental things like covariance. For example, we will take the covariance of gold and S&P 500. The result came back NA, so that's further proof my point. If you want to calculate the covariance metric, correlation metric, you gotta delete and eliminate all those extra discrepancy days. And how we do that? We can use the VLOOKUP functions. So first we will copy the trading day that you want to track. In this case, it is the stock trading days, and then paste here. Next, to receive back the accordingly price, we will look up for the date, and the table arrays will be the historical data of your asset. Lock this up, and for the result to come back at price, we'll put 2 in the column index number and false for the exact match. Now we will do the same to others assets. And then we will apply this function to others row as well. Next, we will calculate our daily returns for each asset. We will have the closing price over the opening price and then minus 1. Now, so actually this return that we receive here is identical to the return that we just downloaded from the investing.com's website, so we know that it is correct. We'll move on to the next part, that is making our covariance metric. Click data, data analysis, and covariance here. The input range is all from the asset name to the last of the returns. I want it to be grouped by column, and we will have label in the first row. I want to have a table here, so we have 7 assets and then plus 1 label rows. We will have 8 row and 8 column here. Okay, and then that is our covering metric. And we format a little. And here, let's put the name covering metric. There. So you can see when one asset meet each other here, this is actually the variance of the metric. I will highlight that first to be a bit more noticeable. And then we will fill all the empty cell as we will use this metric later on in computation. Here is the covering between apple and gold. Let's make some stat table. Over here we have all the asset and the component H is return standard deviation and the weight that we assign. Remember that it is all daily statistics, so for the return we will take the average of the daily return that we have here. For standard deviation, actually you have two options to take the standard deviation formula sample and apply to the return here, or you can take the square root of the variance that I highlighted previously. For the weight, let's randomly assign it, so later on we will change the weight to create portfolio variance. There. And for the portfolio statistic, for return, we will use the formula sum product of each asset return and each weight assigned for. For the portfolio risk or portfolio variance, this is a little bit more complicated. We will use the metric multiplications formula, and that is between the weight and the variance. Actually, the weight power by 2 and the variance. So it would be something like this. And that is our portfolio variance. For the standard deviation, it is actually easier that we only take the square root of the risk, and the risk-free rate I take 4.21, that is the 10-year US T-bill yield at the end of the 2024. We will make that into daily by 1 plus the annual rate, power it by 1 over the trading day, that is 252 days, and then minus 1. That. And for the Sharpe ratio, that is really important to us later on, that our most optimal portfolio is to plus Sharpe ratio to be maximum. So it is the exit returns over the portfolio standard deviation. And that is temporarily our portfolio statistic. To be able to grab the efficient frontiers, let's take a look into the fundamental knowledge. So the efficient frontier is actually the upper half of what called the minimum variance frontiers. That means that the efficient frontier represents a set of portfolio that give us the highest return given a number of risks or the lowest risk given a number of returns. It will be a curve, a line like this, and not something like this. So the blue dot here is actually the scatter chart of what is called the possible portfolio that we can make out of our set of assets. So remember that when you grab the efficient frontier, you want something to look like this, not this. So the efficient frontiers start with the global minimum variance portfolio Z, and we will start with this. It is the portfolio that gives us the least amount of standard deviation. So we will start with that. Let's click data and solver. So our objective here is for the portfolio standard deviation to be minimum by changing the weight of each asset, and the only constraint is for the total of the weight to equal to 1. Let's paste this down. Remember, we only take the value and not the formula. If you take the formula, it will actually mess up our calculation later on. So we have our portfolio this here. The next line that actually in the efficient frontiers is our max-Sharpe ratio. You can see that the orange line is tangent with the outer space of the blue hairs, and that is actually our max-Sharpe ratio, or people would call it the optimal risky portfolio. So for that, we will use silver again, and instead of standard deviation, we will put our max-Sharpe ratio to maximum. Anything else is the same. Let's paste this down. The next thing I want to make it actually the max return portfolio. So with this, I will make a maximum a portfolio that give us the maximum return with a given of risk later on. So we'll change this back to portfolio returns to maximum and solve. So with this, you can see that the standard deviation is actually significantly increased. You can see that I have the 5 empty column here, and what I will do with this is actually assign each of these assets a standard deviation and then find the maximum returns that the portfolio could give us. So actually the previous standard deviation plus the differences between the max return standard deviations and the maximum standard deviation of the max-Sharpe ratio divided to 6 because I have 5 portfolio here. So this, and I have the gradually increased standard deviations. Let's apply this to solver, and this objective is the same, changing variable is the same. Actually, we have to add one more constraint for the portfolio standard deviation to equal our assigned standard deviation. Copy and paste this down here. We will do similar to others code. So actually, I intentionally left one here, the mean returns. So the minimum returns of the portfolio will be in the lower half of our minimum variance frontiers. It is not in the action frontier, but I want to add it in because it will create a hook to my graph, so it will make it a little more used, a little more common, conventional to us to see it like that. So let's create a minimum return portfolio. Change this to minimum and then delete this constraint. So we can actually grab our efficient frontiers from the daily returns, but I want to make it into an annual return, so we will better asset it. So let's take the returns, analyze it. 1 plus the daily returns power by 252 and then minus 1. For the constant deviation, it is much simpler. You would take the daily and then multiply it with the square root of the number of trading days. There it is, and we can make our own now, right now. Into insert. Let's take a look back at that. So there's something going on here, and I will make it again. Because the returns for two these two portfolio is the same, I will make it again to see what went wrong. uh, here. So let's grab our charge. And it is a little bit odd because actually it's messed up the horizontal line and the vertical line. We will call this the efficient frontier. The stereo x value will always be the standard deviations, and the y value will be the expected returns. Let's delete this. And that is our efficient frontiers. Okay, and we will temporarily leave it at that, and we will make our CAL capital allocation line. So for this is make an assumption that we will have a combinations of a risky portfolio have contained 7 assets, and one is the risk-free asset or the investable. If the portfolio of risky asset weight is 0%, that means we only invest in the risk-free asset. And if the portfolio weight is 100, that means we only invest in the risky asset. And actually, when the portfolio weight is higher than 100, that means we borrow money at the risk-free rate to invest our fund in the risky asset portfolio. So for the returns, we will take the sum product, or you can actually do this. Take the returns of max Sharp ratio because that is the tension point between the CAL and the efficient frontiers. Lock this up, multiply to its weight, and do the same to the risk-free rate. For the standard deviations, we will take the standard deviation of max Sharp ratio and then multiply it with the pot weight only because the risk-free asset, as its name, inherently have no risks. And is that. Next, we will add this into our charge. Let's call this CAL, and x value is standard deviations, while the y value is the returns. So okay, so actually standard our max Sharp ratio has some problem, and here is our correct. Okay, so now you can see it is actually tangent at one point, and this point have the returns and standard deviation of the max Sharp ratio portfolio. So now let's add some more element to it. Click chart design. I want no grid lines, so this is this. And let's add some more element like the chart table and the asset title also. Let's call this efficient frontier and CL. The asset title will be standard deviation as it is, and the vertical name will be expected return. For more detailed opponent, you can click the chart. And for example, you want a little tick mark in the horizontal or vertical line. Click this. I want to add both major line and the minor line, so you will better assess where is the number actually is. Do it similar to the vertical. So it will be something like this, and with a little bit more adjustment in the font type, etc., you will end up with something like this, a more refined, yet it is simple to look at. So that is my video for the portfolio optimizations. I hope you enjoy this and see you next time in the following video. Goodbye.